Today we're going to talk about modern U.S. financial regulations and how to use them to create inclusive investment offers. And when I say inclusive, what I mean is allowing people to invest as little as $100 or more in startups. So just a little quick history. Before 1933, there were no financial regulations in the United States. There was just general business law, and people could assemble capital from whoever they wanted in whatever way they wanted. And without going deep into the history, in 1933, the U.S. federal government decided to regulate the finance industry and created a piece of legislation called the Securities Act of 1933. And effectively, the Securities Act curtailed free speech in the advertising of financial offers. And when I say curtailed, what happened was there were ways to raise money, but they typically involved either spending a lot of money with attorneys to follow the new regulations, which was really only possible for big companies, or they excluded smaller investors from projects that became known as accredited and non-accredited investors. Roughly in today's era, in the U.S., an accredited investor is somebody who has $1 million or more in their portfolio or earns a few $100,000 a year on a regular basis. So again, those rules, to comply with the accredited investor rules, that's the cheapest way to legally do an investment offer, or it has been. And if you want to include any non-accredited investors in the U.S. In an offer to fund a startup, the compliance costs can get so high that it's just not worth it. There are many other laws that, once this field started getting regulated, the whole decision about who should invest and how became very convoluted. And really the net result is that entrepreneurship in the United States has actually been on a steady decline because it's been so hard to raise capital. Well, recognizing that, some successful people in finance decided that it's time to make some adjustments to the Securities Act so that we get broad participation in our culture again and allow entrepreneurs to raise money from people other than their friends and family. Because if you look at it, even that alone, that is a very, what you might call elitist kind of law, because who has wealthy friends and family? Well, the already wealthy. That means entrepreneurship in lower income communities becomes very, very sketchy and difficult, or at least difficult to do legally. And so in my way of looking at history, the 1933 Securities Act has contributed substantially to the wealth inequity in the United States. And right now we're seeing some reemergence of what's called the progressive movement, more on the left than on the right, but overall it's not so much of a partisan notion. It's just a notion that really the access to wealth, the fairness of culture, it's getting a little too tilted toward the top. Now, unlike some progressives, I don't have an axe to grind against wealthy people. I just look at the system and say, how did this happen? And how this happened is the Securities Act of 1933 just made it easier for the wealthy to get wealthier and harder for the middle class and lower class parts of our culture to assemble capital and participate in the wealth creation process that is capitalism. So in 2012, there was something called the Jobs Act. This was in the works. It really wasn't a partisan thing. It just so happens that President Obama was the one that signed it. He was in office when this got passed. And the Jobs Act created this thing called Title III. and we're going to talk about Title III now. And Title III had three parts, three different equity. They call it crowdfunding because it's a move to reinstate the public offer. And the unique thing about investment crowdfunding compared to before 1933 is that you can advertise publicly into companies, but those companies may or may not ever go public. So it's really getting the public involved in private investing in a way that became pretty much impossible after 1933. Now, since on November 2nd of 2020, which is this year as I'm doing this video, on November 2nd of 2020, the Title III rules got upgraded in a way that I and everybody else in this field was very happy to see. So when I talk about the Title III regulations and rules, I'll be talking about the modern ones. As of November 2nd, those will be in effect, if they're not already, they'll be in effect in January and February. They're already voted on by the Securities and Exchange Commission. There's a process. They have to get published in the Federal Register, and then 60 days after that. So again, by the end of February, everything I'm saying here will be the current state of affairs in U.S. finance regulations. So with that little preamble, let's get into the interesting part of how crowdfunding works and why these different regulations exist. So if you're watching this video, you probably are most familiar with some of these crowdfunding sites that you've seen, like WeFunder and Republic, and there are corollaries around the world because this trend is not just to the US. The idea of giving more freedom in the realm of capitalism has been spreading, and I just spoke to an expert in the field a couple days ago. He told me there's forms of crowdfunding going on even in Thailand, where only a few years ago the laws pretty much prohibited capitalization of any company from anyone except your friends and family, which of course that assured that only the wealthy could fund new companies. So there is a liberalization of capitalism, which I think is a good thing, so that people can be creative and fund new ideas and get things done. A lot of really great ideas come from, we'll call them the underserved communities, because they've got big problems, and people, creative people are working on solving those problems as well. And if you're in that community, you're going to know because you live it every day. All right, so regulation. So most of the crowdfunding sites rely on something called regulation crowdfunding, or Reg CF is the shorthand of that long regulation. That is the name of the regulation crowdfunding. So what Reg CF allows for in the new rules, it allows for an issuer, which could be the entrepreneur in general, it's going to be the entrepreneur, to raise up to $5 million. And the increments can be quite small. It could be as small as $100. I'm not sure if there's a particular rule. Maybe it could be less even. And accredited investors are allowed. So non-accredited investors the amount they can invest in Reg CF offers during the year is capped. And so this is the government's attempt to keep people who are at the lower end of the economic scale from putting too much of their money in these very high-risk deals. So if you go look at our blog, you'll see some articles where I have a quadrant of risk. But let's just say early-stage investing is high risk, high return. Whereas I look at investing on, say, in the public retail stock market, Wall Street, I consider that high risk and low return, or moderate risk and low return. So definitely investing in startups is high risk. Anybody, whether you're putting $100 or not, you should be prepared to lose all of it. Unfortunately, because of misunderstandings about how capitalism works, often people who don't have a lot of money think that somehow magically they can invest 100 or 1,000 or their whole life savings, and then they'll become, the next billionaire from that. It doesn't quite work that way. So the U.S. Securities Exchange Commission is still keeping a pretty heavy hand on what non-accredited investors can do, but at least they can participate in a way that is not, it doesn't expose them to undue risk. And during the Great Depression in the 1920s, what happened is naive people, put their life savings into new IPOs that were truly nothing but intended to defraud the public of their money. And along with other companies that may have been well-intentioned, just crashed anyway. And so a lot of people that couldn't afford to lose the money they invested did. And then there's a big problem because having an older generation, when grandma and grandpa invest their life savings and it goes to zero, that's pretty hard to recover from. And that created a whole class of impoverished retirees. So that's a longer story, but that kind of thing led to the creation of the Social Security system in the U.S. So at least people wouldn't starve to death in their old age, no matter how they handled their finances. So that's a kind of a tangential thing, But a lot of the way things look really comes from that era, and now we're in the internet era. And so out of respect to the internet era and the way that people talk about things, and noticing that the original crowdfunding sites like Kickstarter, these were not allowed to sell stock. They were just allowed to collect money. Maybe people would give them a gift or a pre-sale of their product. But those were not investment sites. But the success of those pretty much showed the government, it's like people want startups to start so badly, they're willing to just give away the money. Why not allow them to get an investment in case the company happens to succeed? So that's the evolution of these crowdfunding regulations. So regulation crowdfunding, it's open to all American investors. It can be, in various cases, restricted to non-U.S. investors. That's really on a country-by-country basis. And we're not going to go through that today. But if you go to a regulation crowdfunding site, you'll see whether or not you're allowed to invest depending on what country you live in. So again, Reg CF allows an issuer to raise up to $5 million from the entire general public. The total investment per deal and overall is capped for non-accredited investors. But for accredited investors, they can invest as much as they want because the government figures if you're a millionaire or you've got a nice high income, they don't want to get in the way of you losing all your money. So be forewarned in that way. So that's really a great thing for entrepreneurs, that they can really raise enough money from the general public now, and they don't have to just rely on their friends and family. And that's really important for vegans. I like to joke that once you go vegan, you don't have any more friends and family. That's obviously changing as more people go vegan. But that's part of the trouble of being vegan in the first place, is social pressure, disalignment with, the last 12,000 years of animal agricultural history. So, we're definitely not part of the mainstream culture yet. And so as a result, it makes it even harder, 20 times harder for vegan startups to find capital, just because their network of friends and family they grew up with, for the most part, is not vegan. Okay, so that covers regulation crowdfunding. The next regulation is called a lovely name, Reg D 506C. Shorthand is usually 506C. Now, under this rule, an issuer can raise as much money as they want, but no non-accredited investors can participate. And they can advertise publicly. So you can say, well, if I advertise publicly, some non-accredited people are going to hear about it and try to invest. And as a result, you have to do an actual accreditation verification of each investor. So the investor has to reveal whether it's a letter from their lawyer or their accountant or some bank statements. They have to actually prove that they are an accredited investor before they're allowed to invest. And the issuer is responsible for preventing any non-accredited investors to participate. So again, this is a very easy route for companies to raise capital, except that they can't engage the general public fully. They can advertise the general public, but only receive capital from accredited investors. And when I say the easy route, we'll get a little more into this in a minute. I think I'll save this part after we've covered the third aspect of Title III. So the third aspect of Title III is something called Regulation A and Regulation A+. And really the difference fundamentally is that Reg A is for large offers, but smaller. And Reg A+ is up to the max of $75 million. And so these kind of offers can, again, be floated to the general public. So you might ask, well, why have regulation crowdfunding versus Regulation A? And so first of all, regulation crowdfunding is limited to $5 million total. It's really designed for very early stage companies. In general, an early stage company is not going to start with $75 million. They don't really need that much money in the first round. Again, I'm not going to go into a whole lot of financing strategies, but the government said, well, there's a need to raise larger amounts for larger companies so that they're not stuck in the venture capital pipeline. So the venture capital pipeline can be very narrowing. Whereas if you can go to the public, now you've got broad opportunities for raising capital on terms that are more appropriate. And especially if you consider that venture capital firms are essentially wholesalers to the retail market, then all these crowdfunding offers are what I call direct-to-market sales of investment products. And that creates a lot more flexibility on what kind of companies are going to get funded, because VCs like apps and things that really skyrocket that they can buy in Silicon Valley and not that many other places. So if you've got a company that is doing more infrastructure, it's not necessarily going to grow like a rocket, take off like a rocket. The VC style of capitalization may not really work well for your company. So this creates a broad and alternative means of capitalizing things that are important for our culture. We're looking at a deal right now that's a tree planting project. Now, that's not going to appeal to a venture capital firm because it requires a lot of capital, and the annual rate of return is going to be lower than what most venture capital firms are looking for. But the general public would love this. If it comes together, we'll let you know. But deals like that are not a good fit for the kind of capitalization that we read about in the newspapers or watch, breathlessly on the major media stock channels. Okay, so now let's look at some of the challenges. We talked about regulation crowdfunding, Reg 506C, and Regulation A. So the real challenge of raising capital, because it's regulated, that means you need to pay lawyers to help you navigate the legal system. If you don't, that's really, if you make a mistake in your approach to these finance laws, it can be very devastating for a company. I knew a company one time that they raised a bunch of money, and they said that you're buying trees and that you actually own the tree. And the idea was the trees were going to grow into an agricultural forest and be logged later, and you get the profit later. And so they were trying to claim that this was not a securities offer. They're just selling trees. The state regulators disagreed with that. They said, no, this is a securities offer. They're not like watering the trees. They're not going to cut the tree and sell it themselves. All they're doing is giving you money in the hope of getting more money later. That is a securities offer. So what was the penalty of misfiling and raising money under the wrong pretense? The regulators forced them to give all their money back to the investors. They had to do what's called a rescission. I think that's the right term. Anyway, the government can force you to shut down if you fail to follow the law. So what's my point here? Following the law is expensive, and what Vegan Launch is trying to do is to bring the cost of compliance down to zero for entrepreneurs. So if you go to some of these regulation crowdfunding sites, you'll see, the entrepreneurs to pay through $3,000 up front. They need to pay their own lawyer. And so it can easily cost you $10,000 in cash. Now here you're trying to raise money, but instead first you got to spend money. And, this gets back to the age-old problem. It's like, okay, well, how do I raise the money to pay the lawyers? How do I do that legally? And to learn that art, you have to become, you get into our entrepreneur mentoring program. It is doable, but most lawyers don't care about that. They just say, look, go get the money and come back to me. I don't want to get involved in that. So there are approaches to do even your very first money legally, but this is just more and more grinding, more and more opportunities to do something wrong. And our goal is just to handle it. But in the meantime, so in general, the fees, let's say that about $10,000 will cover, if you're an issuer, an entrepreneur, $10,000 will cover the cost to raise a regulation crowdfunding offer. The only problem is that has to go through a registered site. And in practice, these registered sites, they act like gatekeepers themselves. So just like venture capital firms are kind of a gatekeeper for capital, these other regulation crowdfunding sites are also gatekeepers because they have to comply with a whole lot of laws and rules to run that site. And getting one of those sites set up is very expensive. And we're working on that here. We'll have more news about that later. So it's very costly to do that, to set up a regulation crowdfunding site. So regulation crowdfunding, you can't just take out an ad and just tell all your friends in Facebook or whatever. You've got to have it run through a registered site, and that site typically took up to 6 months and spent just on the regulations alone anywhere from $25,000 to $50,000 to get their site approved by the Securities Exchange Commission. All right, so that's an impediment. Like I said, Vegan Launch, we're working on that. We don't offer that service. If you're watching this video, we don't offer that service in a direct way. We do have ways to handle regulation crowdfunding offers for people who have their own big crowd already. That's another problem with most of the regulation crowdfunding sites. It's like if they put you up there, that doesn't mean that they've got a crowd of people that are specifically looking for your kind of deal. So what Vegan Launch is doing on our platform is we're building the crowd first, a crowd of people that all care about the vegan ethic and the vegan economy. And this makes it easier for entrepreneurs to raise money so that they don't have to go and try to find thousands of people that would like them. And if you think of, right now, as I'm saying this video, there's well over 1,000 unfunded vegan companies that are seeking capital. Now, if they all have to if 1,000 companies all have to try to find 1,000 investors, that's a huge replicated effort. We just don't have the time to do that anymore. The problems in the world are too big for us to get involved in processes that are essentially redundant, time-wasting. And I believe, why am I a vegan, and why did I start Vegan Launch? Because Vegan Launch is a way to solve a lot of the world's problems, environmental problems, social problems, health problems, and of course, and all that happens by giving animals their rights. Just by the simple notion of giving animals their rights and have that become part of our mainstream culture, we handle just hundreds of mega crises all at once. So I love the notion. That's why I do this. Okay, so that's regulation crowdfunding, some of the pros and cons. Reg CF, depending on your lawyer, is going to be, and how you do it, it's going to be anywhere from $5,000 to $30,000 to go do that offer. There are some workarounds for that in general, but again, that makes it a little harder to do that kind of offer in a general way, one of the advantages of Regulation 506C is that the issuer can just post it on their own website, so they don't need to go through any kind of platform. And so if we look at, okay, Reg CF is about 10,000, Reg 506C is, depending on how you go, anywhere from 5 to 30,000. 5,000 is not bad for a certain, it's just the lawyers feel it's not as good. I can't get into all this here. It's just there's so much arcane stuff to know in this field. We're trying to package it all in one way so that we can focus on doing the transactions and solving the problems. But as an investor, we'll have a whole course on this so you can really begin to understand these are the tools of the trade. We want to solve the world's problems and become citizen financiers. We need to know our tools, just like a surgeon needs to know their tool set. Okay, so now, well, that sounds okay, but what if I want to raise $75 million? What does that cost? And again, you have to remember there's marketing costs. So this is just compliance, but you can pretty much get a compliant offer for Regulation A plus for about $80,000 or $100,000 in compliance costs. And again, there are variations on the theme, but you need that. You need some other ingredients. We typically are budgeting about $400,000 per 75 million raised, which is still quite incredible. Because if you look at, like a place like Kickstarter, there are professional Kickstarter marketing firms, and they typically charge $200,000 per million. So based on that, for the same $400,000 budget, you could only raise, you would raise maybe $2 million on Kickstarter. So that's our current kind of general notion, but that gives you a sense of the cost to really realistically get things done. You've got the compliance costs and then the marketing costs. All right, so those are the main regulations. Again, Regulation Crowdfunding, Regulation 506C, and Regulation A.